Well, good afternoon and welcome. Thank you for joining the Economic Club of Las Vegas and our special guest, Dr. Mary Daly, the President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. My name is Rose McKinney-James, and I'm a member of the board of the Economic Club. And I'm particularly excited to introduce President Daly today because she represents an important milestone in the bank's history. I did a bit of quick research, and I learned that since it was founded in 1913, the Federal Reserve, which sits at the highest echelon of US economic policy making, has only in its 105-year history had one African-American and 7 women serve as president at any of the Federal Reserve banks in our country. So I noted that in a recent speech at the National Press Club, she focused on our current economic climate and identified 3 crises: health, economic, and social, as converging into one very difficult moment in American history. She's a trailblazer and thought leader, an economist by training, and she brings a fresh perspective to the banking industry. Now, the Economic Club of Las Vegas was formed in 2013. It's a nonprofit, nonpartisan forum for economic discussion. We curate programs that bring experts on regional, national, and international issues to our Las Vegas audience, allowing for a robust exchange of critical economic issues and trends. The club is also an affiliate chapter of the National Association of Business Economics. And now, before we begin, I'd like to recognize and thank the hard work of our board and our officers. We appreciate their commitment to the club, and without it, these events would not be possible. I'd also like to thank our sponsors for their generous support, both in terms of financial support as well as helping to spread the word and enhance the network of those interested in participating in the club's presentations. Now to the agenda. Today, we're proud to offer you a fireside chat between our own Ken Heck and President Daly, followed by a moderated Q&A session. At any time during the event, using the Q&A button, we encourage you to submit questions to our moderator. He'll organize and present all the questions to President Daly. And now it is my pleasure to introduce Keith Smith, the CEO of Boyd Gaming, an industry veteran with more than 30 years of gaming experience. Keith joined Boyd Gaming Corporation in 1990. He was promoted to president in 2005 and then became CEO in 2008. And he also serves as a member of the board of directors. Keith has distinguished himself as an active member of a variety of civic and community boards, to include his previous service as chairman of the Los Angeles branch of the Federal Reserve Bank of San Francisco. And we are incredibly grateful to Keith and to Boyd Gaming. They've been enthusiastic supporters of the club, and we thank them for their continued participation. So now, welcome, Keith.
Thank you, Rose, and good afternoon, everyone. It's a pleasure to participate in today's event, and a real honor to be able to introduce today's guest speaker, Dr. Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco. I had the opportunity to get to know Dr. Daly about a decade ago when I served as the chairman of the Los Angeles branch of the Federal Reserve Bank of San Francisco. I also want to thank Ken Heck and the board of the Economic Club of Las Vegas for allowing me the opportunity to provide Dr. Daly's introduction today. In less than a decade, the Economic Club of Las Vegas has become a nationally respected, independent forum for discussion of national and international economic and public policy issues. Now on to the main topic, the introduction of Dr. Daly. I was told I need to read Dr. Daly's bio that was provided to me, so as a good member of the Fed family, I will do as I was told and read it. And then, Dr. Daly, I'll provide my own comments. Sorry about that. Mary C. Daly is the President and CEO of the Federal Reserve Bank of San Francisco. As a participant on the Federal Open Market Committee, she helps set American monetary policy that promotes a healthy and stable economy. Since taking office in October of 2018, Dr. Daly is committed to making the San Francisco Fed a more community-engaged bank that is transparent and responsive to the people it serves. She works to connect economic principles to real-world concern and as a sought-after speaker on monetary policy, labor economics, and increasing inclusion and diversity within the economics field. Dr. Daly began her career with the San Francisco Fed in 1996 as an economist, specializing in labor market dynamics and economic inequality. She went on to become the bank's executive vice president and director of research. She has also served on the advisory boards of the Congressional Budget Office, the Social Security Administration, the Office of Rehabilitation Research and Training, the Institute of Medicine, and the Library of Congress. Dr. Daly earned a bachelor's degree from the University of Missouri, Kansas City, a master's degree from the University of Illinois, Urbana-Champaign, and a PhD from Syracuse University. She also completed a National Institute of Aging postdoctoral fellowship at Northwestern University. A native of Baldwin, Missouri, Dr. Daly now lives in Oakland, California, with her wife, Shelley. Now, for my own comments. As I mentioned a few moments ago, I had the privilege of serving as the chairman of the board of the Los Angeles branch of the Federal Reserve Bank of San Francisco. And during that time, I had the opportunity to get to know Dr. Daly as she was a frequent presenter at our board's meetings. As an economist, Dr. Daly was able to provide insightful, practical, and common sense information to the board in plain English. She did not confuse us with obtuse correlation analysis and derivative calculation. In other words, she delivered the information we needed in terms we could understand, which is why she is often referred to as the people's economist. Dr. Daly's ability to explain complex economic ideas in plain language was greatly appreciated by the entire board, and Dr. Daly, especially by myself. Mary was equally as interested in what was happening in the various communities that the board members represented. Mary would ask very insightful questions and probe as to what was driving the trends we were seeing in our local economies. These discussions we were having were being had immediately after the 2008 financial crisis, so there was a tremendous amount of uncertainty in the economy. I've always found Mary to be an extremely bright, charming, and a pleasure to be around. And I am proud to have had the opportunity to both work with her and to offer today's introduction of Dr. Daly. With that, I will turn this over to our own Ken Hecht, President and co-founder of the Economic Club of Las Vegas, and President and Chief Economist of Hecht Wealth Management. Ken?
Thank you, Keith. That was a terrific introduction. Thank you, Rose, and thank you, Dr. Daly. Thank you, everybody, for participating. I'm looking as the number of participants is rising, and I very much appreciate that. This is it's really wonderful to be a part of this, so thank you, everybody. We are live on YouTube, so I also want to thank everybody who is either inside the webinar or showing up on YouTube. We're getting really nice attendance and participation today. I also need to recognize and thank the members of the media who are here. There are quite a few of them. Let's discuss the COVID-19 pandemic. What are your thoughts about where the economy stands today?
So as you said, the coronavirus is really the economy right now. When it came onto our shores in March, it was clear we had to go to shelter in place. It just pushed millions of people out of work. Many millions of businesses shuttered, activity all but ceased in many sectors, and we are left with a pretty sizable economic hole. And so that's the world we live in. The context is we have a pretty sizable economic hole from what we had before coronavirus hit our shores. As we've seen the economy reopen a little bit, you've seen people come back. And so I also think as we're taking the temperature of the economy right now, there's this broad understanding that momentum is still there, but the coronavirus is dictating where we are on any given day.
Well, considering that this current recession was caused by unemployment and the subsequent sharp drop-off in economic activity as a result of all the public response for COVID-19 and pandemic, since the cause of this downturn comes from something outside of the economy, and as you mentioned, there seems to be momentum, is this recovery likely to be different than past recessions?
Well, this is an unusual shock, right? We haven't had one of these since 1918, where we have a health crisis. And the way we said it in the FOMC statement, and I've said this before in public commentary, the coronavirus shapes the path of the economy. And so in that way, as an economist, you're taking the health impact and you're then trying to assess what you do with the economy. So definitely it will shape the look of the recovery, the pace of the recovery. But if you look out there, all told, it's going to be a little bit of a challenging ride because we don't yet have COVID-19 under control. And so that will shape how quickly we can come back, either involuntarily because we have to do shelter in place by law and necessity, or voluntarily because we are all worried about COVID and making others sick or getting sick. And so we just restrain ourselves. So that absolutely dictates today, but also tomorrow.
A follow-up question just came in through a private message. I need you to put a letter. Are we looking U-shaped, L-shaped, V-shaped? People are trying to come up with a summary.
So let me say that we can safely take one letter out of the debate. That's the V shape. So put the V away. But you also have 25 other letters in the alphabet you might want to use and shapes you might want to consider. And I would suggest to all of us that we recognize, and this is what I have to do, we recognize it's just very uncertain. So we're all, I mean, I understand it, we're humans, right? We want to put the letter on today. But the actual world we face is we have 25 letters, and I wonder what it's going to look like because the virus determines the pace of our recovery. So I think that's the main message. Uncertainty is before us. If you wanted me to assign some letter, I'm going to make one up. Imagine I was in grade school. It's going to be a W with a little bit of wiggly tail at the end, which just goes up and down, because what we're seeing is really, as we put toes in the water, we sometimes have to bring some of those toes back, and it's going to be fits and starts, a little bit bumpy, but overall slow and gradual and dictated by the virus.
That's a great response. Thank you for that. Considering that unemployment is front and center for the current recession, measuring employment and unemployment is critical. Yet many of the labor market indicators don't tell the whole story. Which labor market indicators do you follow, and how do you use them to build a more complete view of the national labor market?
So one of the great lessons that came out, there were so many, but one of the great lessons, if you're a labor economist or a student of economics or labor markets out of the Great Recession and its aftermath, was you can't use a single indicator. There is no single labor market indicator that will give you a complete picture of the US labor market and the economy and the people and the pain that comes with economic dislocation. So I personally use a dashboard of indicators. And on that dashboard are all the different unemployment rates that every group in the United might have. So it's white, it's black, it's women, it's young people, it's older people, it's people with less and people with more education, regional unemployment rates, because there's just so much heterogeneity that we have to look at that whole range. But we also need to look at what is understudied, the employment to population ratio, right? Because not everybody in our parlance queues up in the unemployment rate. Many people just leave the labor force altogether and stay on the sidelines fully because they're so disappointed about their job prospects. So we need to look at those who are not even counted in the unemployment rate. We also need to look at things like wages, job finding rates, how many people are quitting. One of the great indicators of a strong labor market is people quit a lot. And you probably experience this as business leaders. If people are quitting at really low rates, that means the economy is not very good. And so the quit rate is plummeted, the job finding rate is plummeted. We have millions of people unemployed, 30 million on the unemployment insurance system. So there's a world of pain out there. And I think the main message is look at the full dashboard or you won't get the complete picture.
Perfect. Thank you very much. In a recent speech, you discussed the need for appropriate fiscal policy to support the United States through this crisis and during the rebuilding process. What types of fiscal policy specifically do you think would be most appropriate?
Well, let me start by separating just shoring us up, building a bridge over the crisis. And that's where you saw the treatments that the Congress is debating currently and that Congress already took up, which is just short-term support that gets people through the crisis. But as the crisis becomes something behind us and not in front of us, then there are critical things we need to do as a nation to really shore up our productive capacity. And I listed three. I called these all in a bucket: opportunity, infrastructure. And let's start with health. We have a health crisis. And so we need a health infrastructure that helps us not only get out of the crisis, but prevent future crises from occurring, because these are really damaging to our economy. So health infrastructure is important. Additionally, skills infrastructure, educational infrastructure is critical. So many of the jobs of the future will look different than the jobs in the past. That was already happening, but COVID's been a forcing function. It's going to accelerate a lot of those trends and leave many people with the wrong skills to get the jobs that will be created in the future. So an educational infrastructure, very critical to our growth going forward. And then finally, a digital infrastructure. I think this crisis has taught us that the digital divide is too small of a phrase to really describe the inequity that people have when they can't get access to the internet and to the digital platforms. That's whether you're trying to apply for a job, be productive on your job, go to school, whatever that is, the infrastructure that's necessary is a digital system that serves everyone. So if you put those three things together, those absolutely increase the productive capacity of our society and allow our people to really lead us out of this recovery, or out of this crisis into recovery.
Yeah, that's an interesting thing, because we're talking about fiscal policy, and that's something that is typically in the hands of Congress, either at the state or the federal level. And I wonder how to get everyone on the same train, singing the same song and supporting the same ideals. I support you, and I encourage your message. I hope people are listening. Moving on, COVID-19, and this is a really, it's an awful thing to have to discuss, but COVID-19 has disproportionately affected people of color, and specifically those with lower incomes, shining a light on the topic of income inequality. And I would like for you to please spend a few minutes talking about how investing in this opportunity infrastructure, the healthcare, the education, and digital access, how do you think this opportunity infrastructure is going to help address this problem?
So this is really something, it's almost so hard to look at that we are tempted to look away, but we have to look at it, right? And if you think about what's happening in our society right now, is the COVID shock, created a health crisis, which has disproportionately affected low and moderate income communities and people of color. Then we had the shelter in place, which by and large threw large and disproportionate shares of workers of color or lower income out of work. So now they've got a crisis of economics as well. And then of course we have the social issues that are coming up about just fairness and access to basic things that we all often take for granted, like educational opportunities and career mobility. So you put all those things together, and what COVID has done, as I said, it's been a forcing function in many ways. It's forced us to look at things, and it's accelerated or widened so many of the inequalities that, you know, you see things long enough and you can sometimes be immune to the need for change. And I think what COVID has done and the social justice issues that have come up, they've really shined a light on those and say we have to make changes. It's really important for our growth. So the three things I named, the three crises we have, really can be helped quite a bit if we can invest in health infrastructure, which, you know, eliminates some of the big gaps in health opportunities for people, allows them to be more productive, creates resilient communities. Educational is the same. The differences in educational attainment across race, they're just so wide that no one can believe it can be a part of a fair opportunity set. So allowing people to have access to education and supporting that, talking about the need for that really helps our growth, shrinks inequality, and allows everybody to participate. And then finally, that digital infrastructure, you know, I think any type, you know, think electricity is really important. Think about what happens if you don't have electricity. Well, what happened in the pandemic is it became critical that you have infrastructure like internet. If you don't have internet access, you can't actually do online schooling. And so think of, you know, I was just having a conversation with the local educators about K through, you know, 6th grade. Every year you miss is a year you're behind if you're that young, right? If my age, you can miss a year and it's okay. Doesn't really change your life. But if you're, you know, in kindergarten to 6th grade, it changes a lot. So having access to internet so that you can learn math, learn reading, continue to learn even when you can't go to school, critical for those families, critical for our future.
Thank you. Thank you. And I'm getting some questions that are coming in, and I appreciate them. I'm adding them. If you see me typing away, it's off to the side. I am absolutely going to put those questions into the moderated Q&A, so thank you for sending them. Please keep them coming in. Brian, I see you. Mike, I see you. So absolutely, keep those questions coming. Thank you. All right, Mary, we were talking about employment a few minutes ago. I want to circle back to that. As an economics major, and I did it twice, so I really meant it. I did it undergrad, I did it grad, I meant economics. They always taught us that full employment was this concept where everybody who wants a job can get a job.
Mhm.
And historically, that number lived somewhere around 5%. Yet in the last expansion, we had unemployment rates below 3.5%. We were all the way down, I think we were at 3.4. And I don't recall, we might have touched 3.3 for a hot minute. What does full employment really look like? And what should be our benchmark for full employment moving forward?
That's a terrific question. And it's something that, you know, if you're a policymaker or if you're an economist, you really have to be a humble person, which is not something that when people talk about economists, they usually use in the same sentence as our names. But I think it's good to have a good dose of humility. And the reason we need humility is because you have benchmarks, like we had 5%. But then you have to be willing to learn experientially what full employment really looks like. So I think a lesson that came out of the last expansion, we have to hang on to this as we move into, you know, the future expansion, is that full employment is far more Americans working than we thought was possible. So you mentioned right out of the thing, a phrase I often use: every American who wants a job can get one. But we only count those Americans who want a job by looking at the unemployment rate. We learned in the expansion that's not the correct way to count. There are countless individuals sitting on the sidelines waiting for the economy to improve enough that they're attractive to employers. And one of the great things we learned again about employers is that when the economy gets tight, when the labor market gets tighter, they actually take a second look at candidates who they might not have given a first look to. And when I talk to my contacts, what I've heard is that experience is durable. They understand now that they may have been too narrow. One gentleman told me that some of the most loyal and dedicated employees have are people who he took a second look on, and now he's learned. Right? And so I think as economists, as the profession, we have to also learn that in the absence of inflation, which we have been hard pressed to achieve at our target, we need to learn about full employment experientially and really work to eliminate shortfalls of employment, get the employment back up, and think hard about what we really mean by too many people employed. Is that really what we mean? That the unemployment rate's too low? It really has to be linked to inflation to be meaningful.
Well, I'm going to skip ahead because your answer seems to segue perfectly into a question. I used to be a part-time professor of economics at UNLV, and in introductory economics classes, we talked about a concept called the Phillips curve. So for our viewers, the Phillips curve is a widely accepted economic principle that explains the trade-off between unemployment and inflation. But we just ended a really long period of historically low unemployment without any real threat of inflation. Do we need to revisit the Phillips curve relationship? And my own musings, what effect does global competition have on this dynamic?
Yeah, that's a great question, but I'm going to start because I have this, you may have already had everybody take this pledge when they became a member of the Economics Club, is you have to pinky swear that you still believe in supply and demand, that you understand supply and demand are related, and you have to pinky swear, or else, it's like the starting point. So in all seriousness, the Phillips curve is really just trying to equilibrate supply and demand, right? And the idea is that when the supply of workers is greater than the demand for workers, you don't get much inflation, you don't get much wage inflation, you don't get much price inflation. But when demand for workers outstrips supply, then you should see it manifest itself in wages and prices, right? Because 2/3 of costs for employers are compensation. So you'd see it in wages first and then in prices. So that's the basic relationship of the Phillips curve. And so, yes, I still think the Phillips curve is alive. Its death is overstated, right? And there are many, many factors that can interrupt the basic relationship between supply and demand at any given time. That's a very simplified version that I just went through. You know, unemployment goes up or down, it affects wages, and that affects prices. In a perfect model with no frictions and no other things happening, that's beautiful. But we know there's lots of frictions in our society, lots of things that can happen. Global competition is one of them. Another one is that employees are always looking, you know, employers don't like to cut wages in a downturn, so they tend to draw out wage increases in an upturn. So wage growth is slower to respond, in part because they didn't cut nominal wages when it was a downturn, because that's really hard on morale. So there are all these what we call wedges, what I call wedges, that can disrupt the basic relationship that is the Phillips curve. So the Phillips curve is, and as you said, much, much flatter than it was. If you thought there was this one-to-one relationship that happened on a, you know, unemployment went down, wages went up, and inflation went up, that just doesn't exist. It can take years for that change in unemployment to manifest itself into wage growth and price inflation. So, but being flat doesn't mean it's not there. It just means that in the economy we have today, and this is structural, we have global competition, we have low neutral rate of interest, we have a variety of things that disrupt that general model I just described. In this world, we have a little more room to run in terms of reducing unemployment before we see it spur a pickup in inflation. And that room to run is actually a gift, right? Because it means we can push unemployment down and we can get more Americans into work, into the labor market, and that's a good thing. Run a more inclusive economy, run a more successful economy.
You had mentioned just now, we were talking, you made another comment about workers and employment. So let me pop back over there for just a second. And again, I keep talking about employment because it's so critical to our current recession. During recessions, and what you had mentioned was that employers are hesitant to lower wages during bad times. So during a recession, though, the workers who are let go are usually the last ones who are hired.
Right.
And how do we find work for these displaced workers? And at the same time, how do we narrow existing wage gaps when those workers are part of a disadvantaged group?
Right. No, that's a terrific question. It's top of mind for me. So my own sense of how to do this, I've thought about this a lot throughout my whole career, is the foundation is you have to run a good economy. And so you see it in the Fed policy making, you see it in anything I say publicly as a policymaker, as a Federal Reserve policymaker. I am dedicated to achieving our dual mandate goals of full employment and price stability. And so I'm thinking about what is necessary in Fed policy to ensure that the economy gets back on its feet and can move forward. And right now, we're shoring people up while COVID is with us, but as COVID gets behind us and as we get control of the virus, we're going to need to continue to provide support in order to ensure that we get those Americans back to work. So a good economy is the foundation. Now, once you've got the foundation built, what else is necessary? Well, that's where I harken back to the educational infrastructure. You know, disadvantaged workers often are people who with less education. You know, we know that wages rise and employment opportunities rise with education. In fact, we often think of education as being the best kind of unemployment insurance you can get, because it keeps you from being more likely to be unemployed. All you have to do is look at the unemployment rates by education and realize that college is an insurance policy in that regard. So that's important. Get those workers. And what better time than in the middle of a pandemic when we can't get workers back to work because of the health crisis? Let's try to narrow some of those educational or skills gaps, even vocational gaps, so that we can get workers back to work when the economy starts to improve. That will help us with the wage gap you mentioned, but also with the employment gap. And then I'll finally say that it's important for those employers who hired those workers when the economy was good to remember that rehiring those workers as we recover will be really important.
It sounds like you're talking about public-private partnerships. And again, that to me has got to be the way forward as government is more and more mired down in partisan politics. I think as the private partnerships with the public government, I think that's where efficiencies can actually be created, and hopefully some red tape can be cut. I have a question. that I'm going to bring in from our group from outside. First things first is one of our board members is giving you a shout out about Baldwin, Missouri. Apparently, one of them graduated high school in Baldwin, Missouri at Parkway West, and
Wow.
And wanted to share that with you. I thought that
That's
was
terrific.
ironic. There is a question though that I do want to get back to the topic, but his name is Brian, and I'll connect you both after the event.
Terrific. Thank you.
We're on the topic of unemployment, and people who are affected disproportionately. Someone asked a good question, so Mike, I'm going to ask your question here. Do government stimulus checks and the extension of unemployment bonuses, how does that affect the economy? Is it contributing to inflation? Is it devaluing the dollar? Is it disincentivizing people from returning to work? How do you respond to that?
So here's how I think about it. And you know, anytime you offer a benefit, a policy, all policies, they have costs and benefits, right? And when I tally up the cost versus benefit, so let's take an example. So one example is that you might think that having extra unemployment insurance money provides a disincentive to go and take a job back. And so first of all, you can't actually if you get called back, you have to go. And if you are looking for a job, you might search longer if you have more benefit money, given economics, but theory. But what we're finding is that the net effect on the economy is that there's very little of that. There's very little of that. Certainly you can think of an anecdote here or there, and I've heard them myself, but there's very little evidence that that's a broad thing. In fact, the job finding rates are highest in areas where unemployment benefits are highest. So there's not that direct link between the amount of money you get and whether you search for work or not. But there is, and this is really important, is with a double underline, there is this really positive benefit of the unemployment insurance checks that mean that families can pay their rent, buy groceries, buy clothing, get better school supplies. That's important not only for their well-being and the community's well-being, but it also is part of this consumer demand you see and the consumer spending that is shored up. And so COVID's given us, in economics parlance, a huge demand shock. And so to the extent that we can have our families in the United States continuing to spend, continuing to have the means to participate, that actually offsets some of the demand shock. So my net, if you will, is that this has been a positive part of the support for the American economy. And that if we don't ensure that these millions of workers who were displaced continue to get the resources they need, that's like having a little bit of a fiscal cliff, because we're going to see this drop off and we're going to have that negative demand shock really hit us full force. That's bad for families, bad for businesses, and really bad for communities.
Perfect. Thank you. Thank you very, very much. I have to ask a question that some people have forwarded to me, and it's important to ask. There are some Fed followers that have expressed concern that U.S. monetary policy might be contributing to rising income equality by supporting the banking system and the stock market at the expense of everyday workers. What's your take on this criticism of Fed policy?
Well, when people look at this, and it's right to look at it. So let me just start by saying this is exactly the kind of debate and discussion we absolutely should be having. For all of our policies, be it in fiscal or Federal Reserve, we should be actively, like we say in my research function, we shake the tree, right? We want to make sure that we're analyzing costs, benefits, unintended consequences, good consequences. And so I really appreciate the question, and I actually appreciate the concerns that people have raised. So we've taken this here in San Francisco and across the system seriously and said, okay, what are our policies doing? So let me share with you what we've learned. The first thing you learn is, if you look at the policies, is that inequality can be measured in a variety of ways. So there's consumption inequality, there's wage inequality, there's income inequality, employment inequality, and importantly, wealth inequality. When you take, when the economy expands and we just stimulate the economy, what you see is employment gaps decrease, wage gaps decrease, income gaps decrease, employment gaps decrease. All of the things that we care, that really put money in people's lives, those gaps decrease. What grows is the wealth gap, because that's the asset, right? The asset valuations usually rise when the economy is stronger or when the Federal Reserve is accommodating the economy. You see that it's supporting the economy. Investors have a better outlook than they had before, and that raises asset valuations rise. So that's going to raise asset valuations, but raise wealth inequality. And especially since not everybody has access to assets. Not everybody owns a home. Not everybody participates in the stock market. And so that kind of inequality is going to rise. But the other types of inequality I mentioned are going to decline. So when I net that out, I think of our policies as supporting the average American extremely well. And this wealth inequality calls into question, should we be thinking about additional ways to ensure that everybody gets to participate in asset building, even if they don't have the ability to buy a whole share of a stock or buy a home?
Considering one of the policies that people have been specifically targeting is ultra low interest rates, do these low interest rates really spark that much economic activity other than mortgage refinancing, which we discussed really only helps the people who already have wealth assets?
Absolutely. And so that's another terrific question. So when I think about this, here's what I look at, right? I see we lower the funds rate, and does it intermediate to other markets? Do other rates go down? And so mortgage rates is a great example. Those rates go down, and that puts money in the pockets of people who own the asset. But it also allows, let's just talk about mortgage rates for a minute. It also allows landlords to give forbearance or to not raise rents in times of crisis. So lowering the interest rate doesn't simply help the people who own the asset. It helps people who use the asset, either have a rental stream, et cetera. So that's one thing. It also lowers car loans and makes those more affordable for people, or allows people to refinance their car in that regard. It additionally contributes to businesses being able, when we lower the interest rate, businesses can get lower cost loans to support workers, get working capital, keep their businesses open. So while it can directly affect a certain group of people, it indirectly affects all of us. And so that's why how monetary policy works more than what we just observe. If we say, well, I don't own a house, so I can't get benefits from it. No, if you pay rent, or you own a car, or you have a job, you're getting some of the benefits of that lower interest rate. Is it completely equally distributed? Probably not. And that's where we need to do additional things, of course, to shore up everybody, not just those who have direct access, but it is something that actually intermediates through the entire economy.
Mary, I have a few questions about the corporate bond market. So there's a current debate going on about the price to risk distortion in the corporate bond market. And we have a professional economist online who would love to hear your take on that. Thanks for the question, John. And also Christopher is asking, is the San Francisco Fed making recommendations on individual corporate issues?
No.
All right, there you go, Christopher. No. But for John's question, what's your view on the debate around price risk distortion in corporate bond markets?
So I'm going to back up from the specifics and just talk about how I think about the corporate bond market and just generally our investors out of alignment with the risks we see. So one thing I want to mention three things basically. So in the corporate bond market, we went in and opened a facility in that market largely because it's really important that people get liquidity when they need it, that businesses get liquidity. If they don't have liquidity, then they can seize up, and that has a huge impact on the economy, even if they have all the assets and they have a decent business plan and the forecast is good. So providing that liquidity is important. That facility hasn't been used very much because once we had the backstop in place, the market kind of remediated itself, and that was it became well functioning again. And then there's this question of, was there too much corporate leverage, or was corporate non-financial corporate leverage elevated in advance? And was that about, risk appetite and people being a little bit more confident than they should have been before we even got into the crisis? And I was on record for saying there was a little bit of that. I had a little bit of concern that there could be a correction in that corporate market because there was too much optimism about where that was going to go in the future, and there'd be a correction. And then we got COVID, and you saw the vast number of businesses that immediately saw that their business plans were no longer viable, at least over the time we had COVID, and maybe need to be changed for the future. And so I think there's been some repricing there. But I continue to be curious about two competing things. One is my contacts in business, when I talk to them, are very risk averse, feel very cautious, and face a lot of uncertainty. And the stock market and even the bond market seem to be more optimistic than that. So the pricing seems out of alignment in many occasions with what I'm hearing from my contacts. And I am, looking carefully and watching carefully how that gets resolved.
I can tell you, as someone who is a stock market and economic watcher, when I hear that CEOs and CFOs are risk averse, it's one of the reasons that it allows stock market, in my opinion, it allows the stock market to be slightly more optimistic.
Okay, that's a
All
fair
right.
point.
I have some questions about the Federal Reserve itself and its role. And as I'm getting questions coming in, I'm trying to take the new questions and work them into the questions that I had planned to ask you. I hope that's all right. You're doing
Yes.
great.
Of course. Well,
So
thank you. I'd
for-
like to do well.
Thank you for adjusting as we're getting these questions coming in live. But we have a highly engaged audience. These questions are really
That's
great,
terrific.
so keep them coming. The Federal Reserve banking system and the Federal Reserve Bank nationally has been increasingly engaged with the public.
Mhm.
What is the role of the Fed traditionally, and how is this evolving?
So that's a fascinating question. And so in a quick minute, let me tell you a little bit about it. So we've always been an organization where we need to serve the public. We're public servants. We're by definition, that's what we do. Our work touches every American and countless global citizens. That's always been the case. And we've traditionally, historically, been very bad at talking to the people we serve. We've just thought we'll make the policy, we'll give it out, and we didn't have that degree of dialogue. And we had more of a, just we're earnest, we do our best work, and then it percolates through the economy, and that's the way it worked. But I think that was already chipping away, and then we had the financial crisis. We got to go back a crisis ago. The financial crisis really taught us that you need to be in constant dialogue and you need to be transparent. And so under Chairman Bernanke and then Chair Yellen and now Chair Powell, you're seeing this evolution of just being more transparent, because transparency is good for economic actors, right? It's better when businesses and households understand what we're up to so that they can plan and move. It's also really good for data collection, right? If you don't talk to people, you actually don't see what's happening. If I wait for the published data to come out when we're in a crisis, I'm a month behind. I have to be talking to business leaders, talking to community leaders, talking to government officials so that I can keep up with what's happening today, not a month ago. And so that became really important to us. The final thing, though, is I think the final thing I'll say about this is that conversation breeds accountability. The way we're accountable to the American people who we serve is for them to be able to understand what we're doing and raise questions about, I'm not sure I understand that. Why is this important? Why are you thinking about that? You just go back to the question you asked me about inequality. That should be a discussion we're willing and able to have, and we really lay out the story of why our policies are supporting the American economy, despite the fact that a marker or two markers might show that those things are at odds. And I think those conversations are healthy, they make better policy, and we have to be open and engage with the community in order to do that.
Thank you. And I have to tell you, as someone who my job relies on what the Fed is saying and doing. In the old days, I used to have to watch TV and wait to see when Alan Greenspan was walking out of his brownstone, did he have the thick briefcase or the narrow pad folio to understand, was he going to recommend changing rates or not?
Yeah, the good old days, right?
Well, the good old days, it's funny. I'm not sure how good they were, but 2020, I think anything before 2020 was the good old day. I do have a question about the Fed and inflation. The core PCE, Personal Consumption Expenditures Index, has averaged below 2% for many years, and it is one of the Fed's target indicators. is that 2% target too high? And if it's not, what makes you think that the economy will actually reach this 2% goal?
Right, so we look at headline inflation on this on the PCE, and we look at the core because it's a good underlying measure, right? Because it takes out the volatile components of food and energy and allows us to really get a good reading on underlying inflation. And you're quite right, whoever asked the question or upvoted it, we have failed to sustainably get to 2% over the duration of the last expansion. And so the question is, and it's a reasonable question, should we think about a different target? And here I will say this, that I want to separate out what we've been able to deliver from what the target should be. And the target has to be based on what we think a good cushion of inflation is, so that we don't propel ourselves into the equally harmful disinflationary or deflationary cycle that Japan has gotten itself into and that Europe is struggling to stay out of. Those are very harmful to the economy. If you're a student of Japan at all, that lowers spending. People are always thinking, well, the price will go down tomorrow, so I won't spend today. This is very disruptive to an economy. And so we want to ensure we don't hit that place. And since inflation is mismeasured, we can't always be perfect on how we calculate it, right? It's a survey, we're doing a calculation, publicly collected data. Then you want a little bit of a buffer so that if you do get a negative shock, you have enough to absorb it. So that's the second reason to have this 2%. So 2% was something that economists, researchers, policymakers, the Fed all looked into and said 2% really has been a good buffer for us, because if we get a shock like COVID, it doesn't push us into negative territory. So that's a really good thing. The other thing to think about on the positive side of having a 2% target is that, you know, the interest rate, the nominal interest rate is inflation plus the real rate of interest. The real rate of interest is on a downward trajectory, hovering, or, you know, some people say it's 0 right now, but hovering, and say in my baseline, it's 0.5. So if you have inflation that falls below 2, you end up with almost no policy space. So for every little bit of inflation we miss, our policy space, our ability to lower the funds rate, the nominal funds rate, is constrained. So that 2% becomes a really crucial target for us to achieve. And so then the next question people ask is, well, why do you have any confidence you can do it now since you couldn't do it before? And I'd say first thing that I look to for confidence is commitment. We are committed to achieving 2%. And so we will get there. And as you saw, the policy that we were taking prior to the downturn, prior to COVID, we had taken out some extra accommodation because we were missing on our inflation mandate and allowing the economy to run a little bit more so we could get up to that 2% on a sustained basis. So I have confidence we can do it in the future, and I believe 2% is the right cushion.
Question. With interest rates this low, what tools does the Fed have left to try to spur the economy or support the economy?
Well, let's just use the recent events. So when COVID hit our shores, we lowered the interest rate to near 0, and then we immediately opened several facilities. There's now a whole alphabet soup of facilities that you can go and look at. But you know, people use that language, alphabet soup of facilities. But each of those facilities targeted at a specific area of the financial market that was dislocated, so that it can make sure that it works, so that we're the lender of last resort. We provide liquidity when liquidity fails. And then we also have our Main Street facilities. So those are all tools that allow us to ensure that our interest rate cuts can intermediate through the economy and provide the mechanisms of liquidity that allow lenders and borrowers to make a deal, go forward. So that's much needed support, and so that's another part of our toolkit. But if you think about the funds rate, so those are other things in our toolkit. But if you think about the funds rate, you know, we lower the funds rate. Another thing we can do, and we did do, is forward guidance. And forward guidance is just it's a terminology used to say we're going to tell people how long the rate's going to be low. So if you look at our FOMC statement that came out in March and has come out subsequently, it says lowered to 0, to near 0, and policy will remain here. You know, paraphrasing, policy will remain here until we're back on track to achieve our dual mandate goals. So if you're an observer, you look out and say, we've got unemployment that's still very elevated, inflation that's still very low. That's not close to our dual mandate goals or being on path. So the funds rate's going to be accommodated and low until we get back on that track. So that's forward guidance. And then of course we have quantitative easing, the balance sheet policies, which can help us, especially we used them in the aftermath of the Great Recession to keep the low end of the rate spectrum down. to flatten out that yield curve so that we were able to, incent people, or allow rates to be such to incent borrowers to borrow both at the short and the longer end. So those are all tools we have and we'll continue to use. And I think the other thing that's been very powerful, and I'll just say it as a Fed policymaker, when we've announced things and said we are, and having Chair Powell say, we are prepared to use the full range of our tools to support the American economy and get it back on its path to growth, that is a powerful tool. Our willingness to do it and our ability to back up our talk with some actions that are specific.
And I think the trend towards more and better and clearer communication between the Fed and the public is making that ability and that tool that you just mentioned even more effective and far-reaching.
Yeah, I think this is where, back to this previous question, that's where the transparency comes in, right? If you were simply looking for a briefcase size, then you would be much less able to react to that than if you have the clear communication from the chair and others.
Right. I'm going to publicly say I really appreciate this person who sent me a question, but it delves too far into politics, and I'm going to avoid that. So I'm going to thank you for the question and sidestep it at the same time. You can call me afterwards, and I'll be happy to share an opinion with you. The last question I am going to ask today, and we're going to end with this, is that the coronavirus seems to have created or exacerbated existing trends within our economy. So for instance, over the last several years, you've seen a move in the retail sectors from brick and mortar to online. In the last 10, 15 years, you've seen educational offerings online. You've seen technology jumping in from one place to the other. You've seen financial services going online. You've seen this trend that has been slow and stately in its development become extremely accelerated the minute we were all sent home and forced to be at distance. Which of these trends do you think are good for our economy and which are bad? And can you talk about the effect it's having also on employment?
Sure. So, I think here's how I look at it, that we had many of these existing trends already in place, but it was, we were looking at a decade, 20 years before they would really solidify. And I'm going to use my own example here in our workplace. Before we went to work from home as our posture with COVID, we had in our minds jobs that we thought couldn't be done at home. But when they had to be done at home, we switched like that. And now they're being done productively at home. So the good side of that is that we might be able to run, and will be able to run, a much more inclusive workplace, because now we can have moms and dads and parents and grandparents who maybe have to take care of childcare work from home on the day they have to do that, and also be able to be a productive worker. But on the flip side of that, we're also learning that if we all went remote, we're going to lose some of the close connections of collaboration and ideation and all the things that I have a giant glass whiteboard that's the length of my entire wall. And right now it stands somewhat empty because I don't have my teams in here ideating together and sort of thinking about that. And so there's things that just aren't as easy to replace on Zoom. And so I think of those things as there's a new future of work. What it looks like, I don't know. We're actually hosting a conference on this next week. It's just sort of a series of webinars to bring some of the best people in and say, what does it look like? We don't know yet. What I think COVID has done is given us a more open playing field about what we could use than what we went in with. And I think the same is true with retail. I mean, if you think of retail, I can order now in my entire life online, but the minute we were able to go to a store, I was going. Because I just want to go out. I want to see things. I want to interact with people, safe, mask, social distance, not a lot of people in an indoor space, all of the right things. And I think people are by nature, not either or. Things aren't not black and white. So my best forecast, I never forecast things like this, but I'm going to do it for you guys. My best forecast is that we'll learn that we can do a lot more remotely than we thought, and that we still really like to be with each other. So we won't give it up completely and all work from home and shop from home and never go out. We will actually still be human. We'll still want to intermingle. And we have a lot more flexibility now than we did before COVID. And then it's up to us what that looks like.
Mary, thank you. And with that, I'm going to say we are nearing our 1 o'clock hard ending time. So I'm going to thank you for your time. When we originally had booked this, it was meant to be an in-person
I
event,
know.
and we appreciate that. And perhaps once the world normalizes, we'll talk about that. But I have to say, you are similarly personable, and you really are, as Rose said at the top of this, the people's economist, because of your ability to speak in plain English so that people around you can absolutely understand. So thank you for your
Thank
time
you.
and for your graciousness.
What a pleasure.
All right, and with that, I'm going to thank all of our attendees. I'm going to close the event and tell you to please keep an eye on the Econ Club website at econclublv.org for upcoming events. And there will be a replay of this event available on our YouTube channel. Again, Economic Club Las Vegas is the YouTube channel. So thanks again, and take care, everybody. Stay safe.